Good day. My name is Alex Osternick. I'm a software engineer with AI 70,000 and I'm certified by NVIDIA in AI infrastructure and operations since 2023. Welcome to our AI 70,000 2026 IT conference breakout group presentation on the intersection of software, accounting analysis, and AI capital markets. Today we're reviewing Vertiv Holdings, traded on the NYSE under the symbol VRT and in accordance with GAAP accounting analysis from the perspective of VRT's most recent SEC 10Q filing. We'll provide fresh insight into why software, though not a major line item in the financial statements, is a critical and increasingly important component of future revenue and income growth. For a quick tour of how we got here and why this is important, the first industrial revolution of the late 18th century was the steam revolution, which introduced mechanization with steam power. The second industrial revolution was the electricity revolution during the late 19th and early 20th century, which brought mass production via electricity and assembly lines. The third industrial revolution was the internet revolution during the late 20th century and brought us the digital revolution by using computers and IT for automation. And the fourth industrial revolution is our current one. This is the AI industrial revolution, which connects physical and digital worlds with AI, IoT, and cyber physical systems. An important concept I share with some of our top consultancy clients is the AI industrial revolution diverges from the internet revolution in terms of scaling laws. In other words, where you had with the internet revolution literally kids in their parents' basements creating tech startups with billion-dollar market caps, with the AI revolution, it's all about scale. So whatever you do needs to be done at massive speed and massive size. And so without your own token factory, you really should not expect to be a key player in the infrastructure of the AI industrial revolution, if that makes sense. So for a refresher on one aspect of that, on flops calculations, please refer to our one-pager from 2023 titled, "It's All About the Flops." So even more importantly, looking out past and into the future past 2027, the next industrial revolution after our current AI industrial revolution will be the man-machine revolution, which will usher in the era of increasing mechanization of human beings via brain chip implants, prosthetics, internal organs, and you can kind of get the idea from there. So for that neuro aspect, component, and schematic, we outlined it in part in 2023 from the perspective of the brain cerebral component in the research project AI to AGI. So the man-machine revolution, for which AI LLMs will comprise approximately 1/5 of the AGI component, will commence as the hype cycle for the AI revolution begins to wane, during which we'll then begin to see proliferation of, as I mentioned, brain chip implants, integrated prosthetics, and internal organs becoming increasingly mechanized, for which the trajectory eventually leads to 100% machine. But that subject matter isn't the focus of this breakout group presentation, and that man-machine revolution is years, perhaps many years away, and in this moment in time, we're in the AI industrial revolution, which, as I identified in research papers in 2020, would be the primary driver of GDP in 2025, and for which in 2023 I identified the industry not being in a bubble, but actually being underestimated and undervalued. So for all of 2026 and 2027, AI will remain the primary driver of US GDP gains. However, scaling laws will start to buffer the massive percentage gains by Q1 or Q2 of 2028. But there will continue to be above average gains even after that from the AI industrial revolution. And as with my research project in 2022, which at the time correctly identified AI accelerators as the primary must-have go-to for technology moving forward, so too now in 2025, I've identified the critical component of software designed not only for chip integration, management, and acceleration of AI data, neural net calculations for LLMs, but also for managing AI density and complexity that we're now having to proactively manage with the new massive AI data centers which are coming online. Currently, there remains massive, and when I say massive, we're talking about trillions of dollars, and we're very rapidly approaching tens of trillions of dollars of global capital flows into the AI industrial revolution, for which there's multiple capital market beneficiaries of these capital flows. One of these beneficiaries is Vertiv. Today is December 12th, 2025, and with that brief tour of how we got to this moment in time at the intersection of technology, accounting, AI capital markets, and software, let's begin our presentation on Vertiv Holdings. Its ticker symbol is VRT on the NYSE, and we're going to do this breakout today on Vertiv because Vertiv is highly exemplary of the intersection that we're focusing on: technology, accounting, AI capital markets, and software. So the first thing that we want to review very quickly is our AI 70,000 SEC 10Q financial statement parser and extractor with ratios and visuals. It's actually a fairly simple program. We made it open source, so it's totally free. Any company or agency or individual is welcome to use it. It'll take you probably a moment to download, and then once you have it in your environment and fire it up, it'll take you about 15 seconds to access any SEC Edgar database 10Q and extract the balance sheet, income statement, and cash flow statement. And what will happen is it will also convert all the financial statements to key ratios. And then it will also convert the data into visualizations. And then it will also download the data in an Excel spreadsheet for you and PDF with the visuals. So here you can see live on the screen, I'm using our SEC extractor parser. And we went right in, and here you can see all the line items from the Vertiv balance sheet: assets, current assets, cash and equivalents, accounts receivables net, inventory, PPE, goodwill, retained earnings, etc. That's for the balance sheet. Same line items that are most relevant and important for the income statement: revenue, cost of sales, SG&A, OPEX, on and on. Same thing for cash flow statement. We have it broken down obviously into operating, investing, and financing activities, and then of course our program, which again it's open source on GitHub. I'll show you the URL in a moment where you can go to. It will ask you if you wish to save as an XLSX spreadsheet. Just type in the little Y for yes, and then you'll be prompted to literally just click once, and it will run the analysis for you. And then just scrolling through our code here, it will output the metrics and ratios for you on your screen. Here's a summary of the most important accounting ratios: cash ratio, quick ratio, ROA, ROE, efficiency ratios. And we'll get into this into the main presentation in a moment, but as you can clearly see, as I mentioned at the beginning, Vertiv is exemplary in every way, as you can see just from these ratios. And so, our extractor parser program will automatically, as you just saw there on the screen, it will download the Excel spreadsheet for you and the PDF of the graphics. And so you will immediately have this on your local machine, on your desktop. Literally, as you can see, I'm doing this live within about 15 seconds, maybe. So the one thing I just briefly add is it is case sensitive when you enter the symbol. So please remember that if you use all caps, you have to use all caps. And so the only other prompt it requires you to do is you must enter your email address, which is a requirement of the SEC. So with that brief background as to how we got here today, and with a brief tour of our open source SEC Edgar database parser, extractor, analyzer program, let's begin our main presentation. This presentation provides a GAAP-based financial and accounting analysis of Vertiv Holdings' third quarter 2025 results, with a specific focus on understanding how Vertiv's software strategy is transforming the company from a hardware supplier into a software-enabled systems operator, and why this matters for financial performance, competitive positioning, and the robust 26-27 outlook. We'll evaluate revenue growth, profitability, balance sheet strength, cash flow generation, and financial ratios through the lens of how software enhances, multiplies, and protects the value of Vertiv's critical infrastructure business during this massive AI-driven expansion cycle. This analysis relies strictly on GAAP financial statements from the Q3 2025 SEC Form 10-Q, with ratios derived directly from the reported figures. No pro forma or adjusted earnings are used. The central thesis: Vertiv's software does not drive the income statement directly. It shapes the economics of everything on the income statement. That distinction is what makes this a compelling GAAP accounting analysis and is a reason behind Vertiv's extraordinary strategic advantage and robust financial performance. Hardware enables AI. Vertiv's software makes it reliable, scalable, and profitable. Here on the screen, just very quickly, is the GitHub URL that I mentioned to you. I'll leave this up on the screen for a moment. You're welcome to go there and download the code, the program, use it as much as you like. You can use it with any publicly traded company in the SEC Edgar database. Obviously, we're using our program today for the analysis and presentation of Vertiv, but our open source code, which we've provided to the academic and financial and lending and banking community, it's our gift to the community. It's 100% free, and you're welcome to use it as much as you like. So here is the URL, and you can go there and enjoy. So let's move on. Here is the executive summary for Vertiv. Vertiv delivered exceptional Q3 2025 results, as you can see on the screen, for the quarter ending September 30th, 2025, as reported on October 22nd, 2025. Revenue reached $7.35 billion, representing 29.7% year-over-year growth, driven primarily by demand from AI-oriented data center infrastructure. Net income increased to $887 million. As you can see on the screen, that's up 154% year over year, reflecting both operating leverage and margin expansion. And operating margin improved to 17% from 16% in the prior year. The magnitude of the net income growth relative to revenue growth signals true operating leverage rather than accounting distortion. This is particularly important under GAAP, where depreciation, amortization, and stock-based compensation are fully recognized. Free cash flow totaled $1.01 billion. Return on equity reached 26.8%, and the company closed the quarter with a current ratio of 1.83. These metrics collectively indicate strong liquidity, efficient capital deployment, and effective working capital management during rapid top-line expansion. ROE at this level reflects not only earnings growth, but disciplined equity utilization. Importantly, this is not inflated by excessive leverage, something we'll confirm when we get to the balance sheet review. So from a GAAP perspective, we have our free cash flow formula, which we know is operating cash flow minus capital expenditures. So that $1.134 billion minus $126 million is how we get to $1.01 billion. That's free cash flow. Return on equity is net income divided by shareholders' equity. $887 million divided by 3.5 billion gets us 26.75%, rounded up to 26.8%. Current ratio formula is current assets divided by current liabilities. 6.5 billion divided by 3.5 billion, and we get our current ratio of 1.83. Vertiv has competitors in its market: Eaton, Schneider, and AAB. They are also obviously benefiting from this AI industrial revolution. However, and this is a point we will repeatedly come back to, uh, Vertiv, their ROE is 26.8%. Eaton is around 20, 22%. Schneider's around 15, maybe 16%. And ABB is around 18, maybe 20%. So Vertiv is the leader in the sector in ROE. They're also the leader in current ratio and in free cash flow margin. So the accounting insights here is that Vertiv's ROE leadership is achieved without balance sheet stress or risk from trying to lever those gains, unlike some peers that rely more heavily on leverage or acquisition of goodwill. So when we review these 10Q statements and we run them through the extractor, parser, analyzer, you can immediately begin to sort of read through the tea leaves, if you will, and understand where certain companies outperform and why, and where certain companies underperform and why. And certainly today we're here to review a shining example of outperforming and the reasons why. So to fully understand why Vertiv's recent financial performance is so strong and why the next 2 to 3 years look exceptionally robust, you need to understand the role of software. Vertiv's core hardware, power, thermal, racks, is mission critical. But software is what converts that hardware into a continuously optimized system. In AI data centers, the constraint is increasingly systems level orchestration, powertrain plus thermal chain coordination, alarms to actions automation, predictive failure avoidance, and efficiency optimization. Vertiv's software strategy directly targets those value drivers through unified visibility and control, domain-specific thermal control, and now AI-driven optimization and predictive services. And from an economic and GAAP perspective, these software layers lever increased services and software to attach rates via more recurring revenue mix, improve gross margin durability via software services margins typically exceeding hardware. That's another theme we're going to come back to repeatedly today. And they reduce churn via operational lock-in via high switching costs once software is embedded across sites. And on top of that, they expand the quote-unquote share of wallet via owning ongoing optimization and lifecycle services, not just the initial build. This is why having experienced, educated software engineers on your corporate team is critical for success in 2026 and 2027. The thesis that autocode is a replacement for software engineers is wildly invalid. You must have a team of software engineers, not only for oversight, but for vision and for bridging the gap between the agentic AI, the proprietary code bases, and all the other human elements which comprise the inner workings of a corporation, an agency, or a municipal entity. So Vertiv is no longer just a supplier of critical infrastructure hardware. And to be clear, they do that exceptionally well. They are a dominant leader in critical infrastructure hardware. The company is increasingly, though, a software-enabled systems operator, and that distinction is fundamental to its financial trajectory and competitive moat. So we're providing for you insight today into kind of like behind the scenes on Vertiv as to really like behind the scenes what is making them such a dominant winner in this sector and this space. So let's move on to our balance sheet analysis. And what we see here on the screen is, very user-friendly, streamlined, granular, important visuals, really at a very simple level that tells the story of Vertiv's balance sheet. And again, this is auto-generated from our extractor, our parser extractor program. All this is right at your fingertips and will be loaded onto your desktop within 15 seconds. Once you just type in your email address, which is an SEC requirement, and type in the stock symbol of the company that you're interested in. Really and truly, that's the only thing that you have to do. Everything else will be right there for you on your screen in about 15 seconds. So our balance sheet analysis for Vertiv at quarter end, they reported $10.8 billion in total assets and $3.5 billion in total equity, supporting a strong capital base. Liquidity remains solid, with cash and equivalents of approximately $1.94 billion. The balance sheet shows healthy asset quality with no disproportionate buildup of goodwill or intangibles relative to equity. This is important given Vertiv's M&A activity. The current ratio of 1.83 indicates strong short-term solvency, and it also indicates they're well positioned to meet near-term obligations while funding growth initiatives. This ratio reflects disciplined working capital management rather than excess idle cash, as inventory and receivables remain aligned with revenue growth. So from a GAAP perspective, obviously we have our quick ratio, which is current assets minus inventory divided by current liabilities. So for Vertiv, that's $6.5 billion minus $1.4 billion divided by $3.5 billion, and we get our quick ratio of 1.3. Our debt to equity ratio is 0.84, and our debt to assets ratio is 0.27, and that's just total debt divided by total assets. Again, Vertiv outperforms Eaton and Schneider and ABB in these GAAP performance metrics. And Vertiv maintains stronger near-term cash liquidity, which reduces reliance on inventory turnover to meet obligations. And Vertiv maintains a conservative leverage profile with debt-to-equity ratio of 0.84. This provides balance sheet flexibility during capital-intensive expansion cycles like we are in now. And importantly, leverage has not increased disproportionately to earnings. This mitigates refinancing risk and preserves optionality for strategic investments. Let's move on. Income statement analysis. Here, again, we can see some of the visuals that are automatically generated from the extracted balance sheet, or in this case, income statement, and the ratios converted to visualizations from the SEC 10Q. Vertiv had revenue growth of nearly 30% year over year, which is exceptional for an industrial infrastructure provider. Growth is being driven by high-density power and thermal management solutions supporting AI data centers, where Vertiv has established category leadership. And again, it's a competitive sector. There are many high-quality companies in the sector. They're all delivering good results. However, Vertiv is clearly the dominant, most efficient, and most profitable in the sector. And again, our theme here is the software impact on the revenue. Software enhances revenue quality by enabling differentiation between box sellers by enabling differentiation versus box sellers. Hardware can be competed on price and lead times, but software competes on outcomes, uptime, energy efficiency, standardized operations, predictive risk mitigation, exactly what hyperscale and co-location buyers monetize. Operating margin expanded to 17%, while net margin improved to 12.1%, up from 6.2% in the prior year. This reflects both pricing power and cost discipline as fixed costs are absorbed across a higher revenue base. The GAAP insight here is margin expansion under GAAP is especially meaningful because depreciation, amortization, and restructuring charges are not excluded. The improvement, therefore, reflects real economic profitability rather than adjusted earnings engineering. So the software impact on the margins is as software and services attach rates rise, blended gross margin structurally improves because software and services typically carry higher margins than manufactured equipment, supporting operating margin expansion. So again, for the income statement, our standard GAAP formulas, operating margin formula is operating income divided by revenue calculation. That's 17%. Net margin formula is net income divided by revenue calculation. When we plug the numbers in, we get 12.1%. Gross margin formula is revenue minus COGS, or cost of goods sold, divided by revenue calculation. 7.3 billion minus 4.7 billion divided by 7.3 billion, and we get 35.3% gross margin formula. Interest coverage ratio is 18 times. That's operating income divided by interest expense. So 1.2 billion divided by 69 million, we get 18 times interest coverage ratio. Again, when looking against Eaton and Schneider and ABB, Vertiv is the category winner across the board. So the accounting insight here is, while Eaton slightly leads in operating margin, Vertiv's rate of margin expansion is materially faster, signaling stronger incremental profitability under GAAP. The sharp increase in net income, up over 150%, suggests Vertiv is successfully converting revenue growth into shareholder value. This reflects improved gross margins, controlled SG&A growth, and stable interest expense despite expansion. Interest coverage of approximately 18 times confirms that profitability gains are operational, not financial engineering driven. Let's move on. Cash flow analysis. Operating cash flow reached 1.14 billion, with free cash flow of 1.01 billion, as we saw in the opening summary. Cash generation remains robust, funding capital expenditures while strengthening liquidity, and free cash flow all closely track net income, indicating high earnings quality. There's no evidence of any aggressive accrual accounting inflating profits. So again, the GAAP formulas, operating cash flow margin is operating cash flow divided by revenue. When we plug that in, we get 15.4%. Their free cash flow conversion ratio, when we plug the numbers in, 1.008 billion divided by 887 million, we get 113%, or when we round up, 114%. Free cash flow margin formula is free cash flow divided by revenue. And as I mentioned, when we round that up, we get to 14%. So software has already translated financially in the statements. The margin expansion of 17% is not just volume driven. Software and digital services materially increase blended gross margins, incremental margins on growth, and operating leverage because software does not scale linearly with revenue. Free cash flow exceeding net income confirms earnings quality. Software enabled services reduce working capital intensity and stabilize cash generation even as revenue accelerates. ROE without balance sheet stress, return on equity approaching 27% without aggressive leverage, signals that Vertiv is extracting more economic value per dollar of capital employed. That is a classic signature of a business moving up the value stack. Customer lock-in and recurring revenue. Once Vertiv's software becomes the operational nervous system of a data center, the customer is no longer buying equipment. They're buying outcomes. Switching hardware vendors becomes a risk event, not a procurement decision. That lock-in stabilizes revenue, increases attach rates for services, and raises lifetime customer value. Software enables subscription, monitoring, predictive maintenance, and optimization services, creating more recurring revenue characteristics and improving visibility of future cash flows. Let's move on. Here's the financial ratios. So our parser extractor will extract the balance sheet, income statement, and cash flow statements of any 10Q. And again, here today we're applying it to Vertiv, and it will automatically convert those to financial and liquidity ratios and accounting ratios right on your screen. So you can see we have our liquidity ratios, we have our profitability ratios, efficiency ratios, leverage ratios, cash flow ratios. And of course we have, because this is the 10Q, which is the quarterly report, for the quarter ended September 30th, released on October 22nd, 2025, we include the prior quarter as well for comparison. So on your screen, you see the green is the June 30 quarter, and in blue is the September 30 quarter. So here again, Vertiv demonstrates strength across liquidity, profitability, efficiency, and leverage ratios. ROE, as we mentioned before, with the balance sheet, is 26.8%, and operating margin of 17% position the company among top-tier industrial peers. The gap insight here is ratio integrity is high because inputs are derived entirely from GAAP financial statements without normalization adjustments. Everything in this analysis and presentation is 100% GAAP. Nothing other than GAAP. So our asset turnover formula is revenue divided by average total assets, 0.68. Our ROA is 8.36%. Again, Vertiv beats Eaton at 7% and Schneider at 6% and beats ABB at 6%. Vertiv converts assets into profit more efficiently than its peers, which is critical in capital-intensive infrastructure markets. So the idea or the synthesis here is all three financial statements tell the same story. There's no reliance on non-GAAP adjustments, ROE leadership without balance sheet fragility or risk or levered. They're not leveraging things up to expand the returns. Their cash flow is validated, and relative to Eaton, Schneider, and ABB, Vertiv exhibits superior growth-adjusted profitability, stronger liquidity, and higher earnings quality under GAAP. again, it places them, at the very top of the global electrical and digital infrastructure providers. Let's move on. Vertiv software, their software is really the game changer, but you're not really going to see that. The point I'm trying to make is you're not going to see that as like separate line items in their balance sheet or income statement or cash flow statements. So the core strategic question is, what makes Vertiv software a game changer, and how does it translate into continued robust financial performance? Vertiv's strengths include market leadership in power and thermal management, exposure to secular AI infrastructure growth, and disciplined financial execution. The question is the software layer that converts these strengths into competitive differentiation sustainable for future value creation? The ability to scale profitably while maintaining balance sheet strength suggests management is prioritizing sustainable value creation over short-term earnings manipulation. So the answer is yes. So what exactly is the software Vertiv has? Like, what's this product portfolio that is really currently quite a treasure? Vertiv Unify is the single pane of glass for critical infrastructure. It's positioned as an integrated software platform that consolidates power, EPMS, thermal, BMS, and building management systems into a unified interface with real-time insights and integration via open industrial protocols, explicitly designed to reduce complexity and improve visibility control across the critical infrastructure chain. Why is it a differentiator in AI data centers? Because AI facilities are not one system. They're multi-vendor. They're multi-site. They're high-density environments. So a unified operational layer that integrates with third-party systems reduces integration friction and enables standardized operations at scale. Their next product in their software portfolio is Liebert ICOMS, which is thermal intelligence. That's where AI racks live or die, really. Liebert ICOMS is an advanced thermal monitoring and control software with a single point for managing cooling infrastructure, diagnostics, trending, and efficiency improvement claims. Vertiv cites up to 35% higher efficiency. This matters now because thermal instability is a primary operational risk in high-density AI deployments. Software that improves control fidelity, monitoring, and optimization is directly tied to uptime, energy cost, and safe scaling. In plain English, when you're laying out hundreds of millions or billions or tens of billions or hundreds of billions of dollars on these massive AI data centers and all the related components that go into it and come out of it, uptime and energy cost and safe scaling are critical. The next software product in their software portfolio is Avocent DS View, which is rack power management software. Vertiv also sells management software in the Avocent line, which offers secure, centralized visibility control across devices and related rack power management software tooling, as well as 3 other software products used for remote access and control of virtual and physical assets. This matters because at hyperscale and co-location scale, the operational bottleneck is often not the presence of infrastructure, but the ability to manage it securely and consistently across thousands of endpoints. Also, there's the Waylay acquisition, which moved from monitoring to AI-driven optimization. Vertiv acquired Waylay in late August of 2025 to strengthen their AI-based infrastructure monitoring, predictive services, and performance optimization, including real-time monitoring, predictive maintenance, and dynamic optimization of power and thermal performance. This pushes Vertiv beyond like DCIM dashboards into closed-loop operational intelligence. The software can increasingly recommend or automate actions to optimize power and cooling performance and reduce downtime risk under AI workloads. So, Vertiv integrates power, thermal, and building systems into a single operational layer, delivering real-time visibility and control across heterogeneous multi-vendor environments. The software is designed for both local and global multi-site operations, supporting high availability and redundant systems of any scale. The unlimited licensing model for clients, screens, and connections enables customers to expand without friction, allowing Vertiv to scale alongside its customers. Vertiv minimizes deployment time and risk through plug-and-play functionality and factory-tested, pre-commissioned equipment configurations. This approach allows for faster time to market compared to traditional deployment methods. So Vertiv is heavily investing in R&D and strategic partnerships with NVIDIA and Intel to ensure its software and hardware solutions are AI ready. The software supports the high-density power and advanced liquid cooling demands of AI and high-performance computing workloads. So the platforms, they seamlessly monitor a wide range of SNMP-capable devices, including those from other manufacturers, through a unified cloud portal, avoiding vendor lock-in and providing a single pane of glass for all infrastructure management. So this matters with hyperscale, it matters with co-location, and it matters with large enterprise data centers. Also, with edge environments where distributed operations require standardized monitoring and control. So their distinctive strategic position is that it's building data center native software across both the electrical and thermal domains, and then augmenting it with AI-driven optimization via Waylay Unify, ICOM-S, and other predictive AI-driven operational intelligence and operational efficiencies. So I know that's a lot of information, but I cannot stress enough how this specific model is really the key path forward at the intersection of all of these specialties. Their game changer is their thesis really is own the outcomes in AI facilities by controlling the integrated power and thermal operating layer, and then monetize that ownership through recurring digital services and optimization. So that's that's like the key essence, the key insight of Vertiv's extraordinary performance and execution and well-stuffed revenue and earnings channels looking out to 2026 and 2027. And it's really the essence and really the genius of their game-changing thesis. In other words, they they figured out really pretty much before the rest of everybody else when and how these critical issues were all going to intersect simultaneously, and how to be prepared for it, and how to guarantee their monetization. So don't get me wrong, there's other peers in the sector who are very strong in software. Eaton is exceptionally strong in electrical digitization with Brightlayer. Brightlayer. Schneider is exceptionally strong in DCIM and vendor neutral monitoring and management with their ExoStructure IT product. And ABB is exceptionally strong in industrial asset energy digitalization with their ability, capital A ability product. But Vertiv is uniquely strong in data center native and cross-domain, which cross-domain means power and thermal software built specifically for AI infrastructure density and complexity, and that is what commands the highest multiples in the AI capital markets. So again, it took us a while to get here, but the key insight is Vertiv's game-changing thesis is own the outcomes in AI facilities by controlling the integrated power and thermal operating layer, and then monetizing the ownership of that through recurring digital services and optimization. So you're not going to see this, broken down, as line items in the balance sheet, the income statement, the cash flow statements. But when you convert those to financial ratios and look at the ratios, you're going to say, well, my gosh, how do they do that? I don't really see in those statements how that is really getting us to their alpha, and it is alpha. So this is really important because the software revenue attribution, it's not possible to precisely extrapolate the revenue, NOI, or cash flow generated solely from Vertiv's software based on the public financial data, because the company integrates its software sales and operations into its broader products and services revenue segments. Okay, so Vertiv doesn't report software as a separate financial segment. They provide comprehensive financial metrics at the company level, which reflect the combined performance of its hardware, software, and services portfolio. However, you can make an educated estimation of the maximum possible scale of their software revenue by analyzing the services segment and using qualitative data from the reports. First, analyzing the services. The software revenue is bundled either within the products segment for embedded software or the services segment for monitoring, analytics, and ongoing support subscriptions. In Q3 2025, the services segment accounted for approximately 17% of total revenue, or that translates to about $461 million. The remaining 82%, or it's really 17.2% and 82.8%, to be, for the for the mathematicians and accountants in the audience, the remaining 82% came from products, the hardware. The software portion of the services segment is likely only a fraction of that 17.2%. Services revenue also includes maintenance, spare parts, installations, and the field services. But the software is designed primarily to enhance the value and efficiency of the hardware infrastructure, rather than being a distinct, high-margin, standalone service as a software as a service, SaaS business unit. It serves as an enabler for the core hardware sales. Vertiv's capital expenditures on internal software development are really shockingly minimal. Only $4.7 million for the first 9 months of 2025. $4 million, just under $5 million compared to their total revenue, indicating that the software business is not a separate, heavily invested segment in accounting terms. But the truth is, if you look at that ROI and that ROE and that ROA, it is off the charts. I mean, you can barely even quantify it. I mean, it is like super premium octane, to say the very least, and I cannot drive that point home enough. Reports and investor calls primarily focus on overall organic growth, hardware demand, especially obviously for AI and HPC, total operating margins and backlog, treating the software as an integrated part of the overall solution rather than a separate financial driver. So you can infer that standalone quantifiable software revenue represents a small single-digit percentage of total revenue. The vast majority of Vertiv's financials, over 90% really, are tied to physical infrastructure and related services. The value of the software is in its indirect contribution, enabling the high-margin hardware sales and ensuring recurring service contracts, which contribute to the company's strong overall margins and cash flows. This accounting reality does not weaken the software thesis, it strengthens it. Vertiv software does not exist to maximize software revenue. It exists to control the operating environment that determines whether AI infrastructure is economically viable at scale. That is why its impact is observed not in a revenue line item, but in expanding operating margins, high quality free cash flow, elevated ROE without leverage stress, and durable competitive positioning. Again, look at any KPI or any, gap metric, and Vertiv is the winner in the sector. Key opportunities include AI data center expansion, edge computing, and strategic acquisitions that deepen Vertiv's integrated solutions offering. So, considerations obviously would be working capital strain during rapid growth, gross margin sustainability amid capacity expansion, and competitive pressure in critical infrastructure markets. These risks most likely might surface through margin compression, inventory buildup, or declining cash conversion, metrics that you need to monitor, but in no way, shape, or form is there any indication within the industry, the sector, or the company itself, or the financials whatsoever that any of those risks would present in 2026 and or 2027. The pipeline is just too robust. So to conclude, Vertiv delivered an outstanding Q3 2025 performance. They combined it with revenue growth and expanding margins and strong cash flow and disciplined balance sheet management. The company is exceptionally well positioned to benefit from AI-driven infrastructure demand. All three of their SEC Q3 10Q statements and the 2024 annual 10K all present the same story. They confirm each other, and there's no reliance on non-GAAP adjustments. ROE leadership without balance sheet risk. The cash flow validates earnings sustainability. Their performance quality is high. Earnings are supported by cash flow, leverage is controlled, and accounting signals align across all three financial statements. As I said, looking forward, into 2026 and 2027, the core thesis is not that software becomes a dominant revenue line. The thesis is that software continues to raise the value of each hardware deployment, deepen customer dependency, increase services across attach rates, and stabilize cash flows during rapid growth. Under that framework, Vertiv's financial profile is, as I've said multiple times, is stronger than its peers because it monetizes outcomes, not just equipment. So we're going to see continued operating margin expansion. We're going to see even higher free cash flow conversion. And I would say, ROE in the least is sustainable even as the balance sheet grows, and will probably expand as well. So software and digital services increase as a percentage of revenue, earnings quality, and cyclicality issues. They're increasingly positioned not just as a supplier to AI infrastructure, but also an operational partner in AI deployment. That distinction matters enormously in a world where downtime, as I mentioned earlier, is, that's a downtime is a full-on panic situation. In 2025, we've had a couple of mass outings on the internet, and the amount of revenue and earnings impact is the quantifiable amount is staggering. Any type of inefficiency or thermal failure, at the AI data center, you're going to destroy millions of compute value per second, and that destruction. But God, heaven forbid that downtime or that destruction of compute value translates into billions of dollars of revenue per second. Okay, so that is why it's so incredibly important to have, this type of an operational partner in AI deployment. Competitors, as I mentioned, they do have strong software offerings, but what differentiates Vertiv is domain specificity, deep thermal control, deep power orchestration, and now AI-driven optimization across both. This is software built for AI infrastructure, not adapted to it. So, as I mentioned at the start of this presentation, hardware enables AI. Vertiv's software makes it reliable and scalable. So, on the software front, Eaton in electrical digitization, Snyder and DCIM, and ABB in industrial IoT, they are certainly doing well. But Vertiv's data center cross-domain software stack positions it uniquely for the current AI industrial revolution that we are in today. Thank you for your participation today in our breakout group presentation on the intersection of software, accounting, and AI capital markets. The example we analyzed and shared today on Vertiv Holdings clearly confirms Vertiv Holdings as a dominant winner in the industry and why the software behind the hardware is immensely profitable for the company. If your Fortune 500 company, agency, or mid-market business would like AI 70,000 to create profitable software solutions for your entity and generate orders of magnitude of alpha beyond your current business model and performance, exactly like what we reviewed here today, feel free to contact me. Again, my name is Alex Osterneck. I'm a software engineer here at AI 70,000. AI 70,000, where the future is now, the future is AI 70,000. Thank you for your participation in our presentation today. Have a great day.